Hi, Geraldine Barlow, Managing Director and Head of Infrastructure at Affinius Capital. I'm building out Affinius Capital's infrastructure platform. I've spent 27 years in private markets in both Australia and North America, and I've actually had the benefit of leading teams across all major asset classes, even outside of private markets. So I do bring that relative value perspective to the table. I've also got experience on the asset owner side as well as the GP side. So I certainly can see both perspectives there. Different sectors within infrastructure will absorb macro environments differently. So it really does come down to not only what subsector you're looking at, but the individual investment, because even within a sector, two investments can be totally different. And a great example of that is power, right? You might have a merchant power plant on the one hand, you might have a contracted asset on the other hand. Economic growth, interest rates, and inflation tend to be much more cyclical in nature, whereas geopolitical events and shocks tend to be exogenous and much harder to predict, and also will have different magnitudes of impact on different assets. COVID's a great example of that, where you saw some of the beneficiaries being digital infrastructure, but also some of the more GDP-related assets, such as transportation and particularly airports, didn't do as well in that sort of environment. But also what we're seeing is geopolitical events can actually create quite a step change in the profile of an investment. And one thing's for sure, there's no way to really predict what the next geopolitical event might be. And while one can look back in history and certainly do some scenario testing on things like interest rates and inflation and other economic shocks, it's much harder to look into the crystal ball and see what impact the next geopolitical event's going to have. In terms of some of those aspects more specifically, to take interest rates, of all the asset classes, infrastructure has actually absorbed rising interest rates relatively well. And this is compared to equities and bonds in particular, but even real estate. So in the backdrop, GDP and inflation have actually been quite good for infrastructure, and to some extent have offset the kind of negative impacts that one would expect interest rates to have. And as we're starting to come out of that interest rate cycle, I think infrastructure is certainly going to be a beneficiary of the years to come. In terms of inflation, a lot of investors have historically turned to infrastructure for its inflation protection, but there can be a bit of a misnomer. And again, it really comes down to what subsectors and what assets you're looking at. There's also a growing definition of what's in infrastructure. So it's quite dangerous to apply a blanket assumption in terms of inflation and infrastructure being an inflation hedge. The good news is, I think many infrastructure assets actually have that inflation protection built in, whether it's regulation, whether it's long-term concession agreements or contracts, but also where you don't necessarily find any of those features built in. So say an asset has a shorter length contract, what it will really come down to most of the time, an asset's ability to outpace inflation will be how essential is that service. So an asset with a shorter duration contract that is a highly critical service potentially could perform even better than a long-term contracted asset in the face of inflation. Turning to geopolitical, this is one of my favorite topics because it's so diverse. But I think, if we look at the geopolitical risks out there in the economy today, at least those that we know of, they are to an extent interrelated. And it's hard to look at them in isolation, and often they kind of bleed, one geopolitical issue bleeds into another one. If I was to summarize what I see as the main geopolitical issues that potentially affect infrastructure. We have the election cycles, and I guess being in the US, we're particularly focused on the US election cycle, Russia-NATO tensions, the invasion of the Ukraine, the US and China sort of tensions that's certainly weighing on investors' minds, energy security, climate risk, and probably one that doesn't get talked about as much in infrastructure, but cyber attacks and the increased potential for those going forward. All of those geopolitical risks have a bearing on infrastructure, and I think their impacts will be quite uneven. So take, for example, the US election cycle, which I know is front of mind for many investors. Regardless of what the result is, infrastructure should still continue to retain bipartisan support. If you look at the CHIPS Act and the Infrastructure Investment and Jobs Act, they should remain fairly safe, in my view, from rollback. But things like the IRA, which has been very popular, obviously, with the energy transition, may incur a bit of a rollback. I think more so than facing a repeal if a Republican government's elected. But there's no doubt in my mind that the tailwinds behind reshoring and energy transition mean that those two areas are going to continue to grow and are here to stay.